It definitely makes me feel better knowing that despite all of this market turbulence going on this year, that I'll still be able to count on and collect my dividends. The markets can shake as violently as they want to, but I feel better knowing that I can count on my dividends to arrive and that I'm not interested in being a growth investor where the only thing that really matters is the stock's share price. Recently, I decided to go on a hunt for the highest yielding dividend stocks that have a really good reputation for never ever cutting their dividends. So today what I wanted to do was present some of those companies that currently offer yields of over 7% and have never cut their dividends before. It's important to keep in mind that just because these companies haven't cut their dividends before doesn't mean that they won't ever cut them. Dividends are never a guarantee to shareholders, and if a company is going through a particularly bad situation that results in a sizable loss of income, the dividend is usually one of the first things to go. So make sure that you don't just blindly invest in any of these companies, but to do your own research and due diligence and come to your own conclusion before investing. Some of these stocks I'm more confident in than others, and I think the outlook for some look better than others on this list. But a consistent track record of never cutting your dividends speaks a lot about the strength of a business. While it doesn't guarantee future success, I think it does indicate that the board of the company has done a great job in managing the business. They've shown that they've been able to adapt to changes over the years, including various recessions and corrections, without ever needing to reduce their dividend. So today we're going to take a look at just a few of those stocks that have never had to cut their dividend and they currently yield over 7%. So with that out of the way, let's get started. The first stock we're going to take a look at is Whitehorse Finance, ticker symbol WHF. Whitehorse Finance is a non-diversified, closed-end management investment business development company specializing in the origination of senior secured loans to privately held small-cap companies across a broad range of industries. They invest in U.S. companies and typically invest between $5 million and $25 million in companies having an enterprise value of between $50 and $350 million. Since their IPO back in 2012, this company has never reduced their quarterly dividend. While they have paid roughly 35 cents per share for more than 8 years, there have been occasions more recently where they've actually paid a special dividend. These are kind of like an added bonus that a company will pay under certain situations, like if they had a particularly strong quarter or if the board just felt like being generous. Less than 2% of companies pay a special dividend, and they're not something that you can predict, so investors shouldn't count on these kinds of additional dividend distributions going forward. Whitehorse Finance currently offers a generous 9.22% dividend yield, and as I mentioned earlier, they issue quarterly dividends. They're a business development company, otherwise known as a BDC, which is a specialty finance company that invests in small and medium-sized businesses as well as distressed companies in certain situations. These companies like Whitehorse offer loans to businesses that have a hard time getting financing from other places. The reason for this can range from a company being too small to issue stock to being too big to simply go down to a local bank and ask for a loan. This is where specialty finance businesses like BDCs step in to provide that assistance. There's a number of things I like to look at whenever I'm analyzing a BDC, so I'll go over some of them here. An important metric to keep in mind is their NAV, or their net asset value. You can find this in the company's financial statements where it's labeled as their book value in their balance sheet. It's important to make sure that there isn't a falling trend in book value, which represents all the assets owned by the company. BDCs also typically trade around their NAV as well, so for Whitehorse, the situation we can see here is that their book value as of third quarter 2021 is $15.76. This is good because this means that this stock is currently trading below at a slight discount. Another important thing to look at for any BDC is their loan portfolio. It's important to make sure that the loans they issue span a wide range of different sectors, which helps in terms of diversification. It's also worth noting what kinds of loans make up their portfolio. I like to look for BDCs that hold almost all senior secured debt, ideally with a lot of first lien debt. This is considered the safest kind of debt out there, meaning that the first lien debt holders are considered first in line if the company they loan money to goes bankrupt and they have to liquefy their assets to pay their debtors. First lien or any kind of senior secured loans definitely aren't risk-free though. It's possible that a company may go bankrupt and they're so deep in debt that they may not be able to pay back all of their senior first lien debt holders. But a weaker business development company may overinvest in a lot of preferred and common equity as opposed to just senior secured debt. It's not necessarily a bad thing if they're getting a better return or if they have a lot of confidence, but this type of investment is lower in priority in terms of a bankruptcy. Fortunately for Whitehorse, 100% of their loan portfolio is senior secured. Their industry diversification is also pretty strong. Their largest industry is healthcare services, which makes up 9.2% of their loan portfolio, and you can see 43.9% of their portfolio is classified as other, which means that their industry isn't already listed. I won't go too in-depth, but overall I'm liking what I see with this company. I don't have too much familiarity with it, and while its dividend isn't growing if that's something that you're looking for, it does appear to be a pretty solid BDC. I noticed that it's also a lot smaller than other BDCs out there. In fact, according to what I could find, they're ranked 29th in terms of the largest business development companies in this sector, so they are pretty small. but I still think it's a stock worth considering if you're looking for a 9.22% dividend yield. This next stock is one that I don't think is a stranger to any dividend investor, and that's Altria, ticker symbol MO. Through its subsidiaries, Altria manufactures and sells cigarettes, oral tobacco products, and wine in the United States. They offer cigarettes primarily under the Marlboro brand, cigars principally under the Black & Mild brand, as well as smokeless tobacco under several different brand names. Additionally, Altria holds a sizable stake in the e-cigarette company Juul, and they're the parent company of Philip Morris, which will celebrate their 200th year anniversary this year. Their stock currently yields 7.17%, and they pay dividends on a quarterly basis. They're also a dividend king, which is an exclusive club of stocks that have been able to grow their dividend every year for more than 50 years. Additionally, according to their website, Altria has paid more than $27 billion worth of dividends to shareholders between 2016 and 2020. They've also continued to grow their dividend at a pretty aggressive rate when compared to other dividend kings, having increased it by 4.7% in just a little over a year. Whenever people talk about Altria, there's really two main concerns investors have about this stock. The first concern people have is the fact that the tobacco industry has been under fire for many decades, and fewer people around the world are smoking cigarettes. Since the early 60s, the number of active smokers around the world has continued on a downward trend, and since Altria's most well-known brand is Marlboro, many investors worry about the company's future prospects. And while that is a genuine concern for this company, I also think that Altria's leadership is probably one of the most intelligent in the whole tobacco industry. They've known for decades that smoking rates have continued to fall, and as a result, the company has been doing a lot to change their brand. They've built this huge marketing campaign around moving towards a smoke-free future that includes developing alternatives that'll make smokers not only want to transition away from cigarettes, but these smoking alternatives will be less harmful than your traditional cigarette. It's obviously just a huge PR and advertising campaign trying to convince people that they care. I'll let you decide if you want to believe them or not, but one step Altria has made towards moving towards this less harmful future was by owning a stake in the e-cigarette company Juul. The other issue investors have with Altria is the massive amount of debt that this company has taken on. According to their third quarter 2021 financials, Altria had over $27 billion worth of debt. This is more than double the amount of debt they had back in 2018, where they had approximately $11.89 billion worth of debt. Needless to say, this has a lot of investors concerned about whether or not they'll be able to pay this all back. If a company racks up too much debt, the dividend is usually one of the first things to go. But despite these things, Altria still has several years until some of their long-term debt obligations will need to be met. So as of right now, it appears Altria's dividend is still sustainable for the time being. The performance of their stock has also been on a decline for nearly 5 years, but it's been recovering since the 2020 pandemic plunge. So investors appear to be showing a little more confidence in this stock. Next up, we have the Goldman Sachs Business Development Company, which is ticker symbol GSBD. This is a BDC that specializes in middle market and mezzanine investments in private companies. They seek to make capital appreciation through direct originations of secured debt, senior secured debt, junior secured debt, unsecured debt, and investments in equities. Goldman's BDC seeks to invest between $10 million and $75 million in companies with an EBITDA between $5 million and $75 million annually. I remember a while back being surprised to learn that one of the largest investment banks in the world actually had their own business development company. Similarly, BlackRock also has their own BDC that they launched back in 2007. But while BlackRock's BDC has been pretty poorly managed, my own personal opinion on Goldman's BDC is that it's a pretty average company within the sector. They've only been around since 2012, but there are a couple things to like about it and some things to be cautious of. They currently offer investors an 8.83% yield, which is really nice, and it does pay dividends on a quarterly basis. It's currently trading at about 46 cents more than its IPO back in 2015, but it's always paid such a massive dividend that if you would have reinvested your dividends this whole time, you would have earned an average yearly return of 9.69%, which is pretty good. It's always paid a dividend of 45 cents per share, and just like Whitehorse Financial, Goldman has paid special dividends on a few rare occurrences, about 3 to be exact. Their portfolio is also pretty good. According to their latest investor presentation, 98.3% of their portfolio was comprised of senior secured debt, and 89.5% of that was first lien investments. One thing that has me concerned though is their decreasing NAV over the last few years though. As I previously mentioned, this isn't something that I typically like to see with the BDC. I don't care if the NAV is growing or basically flatlining, but I don't like to see a downward trend in this metric. Despite that though, they've been able to keep the dividend the same all these years, which says something about its strength though. Like I said, I think Goldman's BDC is decent. I would like to see more recovery from this company coming out of the pandemic though. In my opinion, there are better options out there. Like for example, Ares Capital is still my favorite BDC, and I'm also a big fan of Owl Rock Capital. Finally, this last stock I want to discuss actually pays monthly dividends, which is really nice, and that's PennantPark Floating Rate Capital, ticker symbol PFLT. This is also a business development company that seeks to make secondary direct, debt, equity, and loan investments. They seek to invest through floating rate loans in private or thinly traded public middle market companies, and it primarily invests in the United States and to a limited extent non-US companies. The fund typically invests between $2 million and $20 million into each business, and additionally they invest in equity securities such as preferred stock, common stock, warrants, or options. They launched back in 2012, and for a number of years, everything about this company has been pretty decent in terms of performance. While share price appreciation has been pretty much non-existent for this company, and they haven't increased their dividend since 2015, it does offer a really nice 8.6% dividend yield, with again monthly dividends. I won't go too in depth since this is another business development company we're looking at, but I've had a favorable opinion of this company for a while now. Their portfolio is pretty decent as it's well diversified. They hold 87% secured debt, which is something that I typically like to see, but I noticed there's a lot of media industries for some reason though. I'm not sure why there's 4 different media sectors here, but added up they make up 17.4% of their portfolio. I consider media along with hotels, restaurants, and travel companies to be higher risk industries than others. PennantPark is also a smaller BDC than a lot of their peers, so similarly to Goldman's BDC, I think their portfolio overall is decent. And that's a pretty good way to describe this stock, which is decent. I like it more than Goldman's BDC despite having a slightly lower yield, but it does offer monthly dividends. If you're interested in a high yielding monthly paying dividend stock and you happen to see a nice dip in its share price, PennantPark might be worth considering for you. There's no growth as previously mentioned, but reinvesting dividends will allow you to build up that dividend snowball if that's something you're interested in. And that's going to pretty much wrap things up. A lot of business development companies, as you can see. AT&T might have made the list had it not been for their recent announcement in which they're cutting their dividend. But it serves as a good reminder to always perform your own research and due diligence before investing, and make sure you diversify your portfolio to reduce the amount of risk you're exposed to. Alright everyone, that's going to wrap up today's video. Thank you all so much for watching, I really do appreciate it. If this video benefited you in any sort of way, please click the like button below and click subscribe if you want to see more dividend investing strategy videos. It would just let me know that there's a sizable enough audience out there who wants this kind of content, and I'll continue to provide you all with that content. Alright everyone, thanks again for watching and I'll catch you next time. Take care.